I think in today's society, there's more things that you need to stay away from with regard to investing. There's a lot of things that are speculative, a lot of investments that are dangerous to get involved in, and the average person can't afford making a big mistake where something goes to zero. So I think pitfall number one is trying to pick individual companies and trying to time the market. People feel often market's too high, particular stocks too high or too low, or makes sense to jump in and out. One of the worst things that you can do is jump in and out of investments, especially when it comes to the stock market. There was a study done, I believe by Vanguard a number of years ago, where they took an index fund, such as one that tracks the S&P, and they looked at the return over a 10-year period, and during that period, the return was around 10 or 11% per year, which is what the historical returns of the market. And then they looked at what the average return is for an investor in the fund, same fund that generates 10% a year over time. And the result was surprising. You'd think that the average investor has the return that's 10, 11%, but in reality, the average investor had a return that was closer to 2.5% per year. Why? Because the average investor goes in and out depending on when they feel the market's overvalued. Oftentimes when the market drops, as it did during Corona in March of 2020, the market fell 34% in a very short period of about 4 to 5 weeks. Of course, it recovered a few months later and then some and continued to grow. But a lot of people felt that things were not going to recover very quickly, and so they sold out. And oftentimes investors tend to sell at exactly the wrong time, and they often tend to buy at the wrong time as well. So I think pitfall number one is to make sure that your time invested stays over the long term, that you're not trying to time the market. There's an adage that says that time in the market is much more important than timing the market. There's another interesting fact that if you look at portfolio return, many studies on this, approximately 90 to 92% of the return of a portfolio is dictated by asset allocation. Simply what percentage you have in stocks versus bonds versus cash. That alone determines about 92% of your performance, whereas the remaining 8% is determined by timing and stock selection, picking individual stocks. So if you look at that, and that statistic's abundantly clear and there's plenty of evidence of it, you're statistically better off just owning investments that are tied to the overall market, not trying to pick individual securities, and certainly avoiding timing, whereas just leaving money in and letting it grow is really the best approach. So pitfalls to avoid: picking individual companies, timing, trying to go in and out of investments, and lastly, going into investments that are very speculative or illiquid by nature generally should be avoided. There's always exceptions. There's always some very smart people that are able to make investments work, but in general, when it comes to investing, it's important to stay relatively liquid. It's important to invest in investments that track a broader asset class, such as buying the entire market, and it's important not to time.